Good day, entrepreneurs. We're going to look at the budget and the projections and also the difference between the two, including the forecast. The purpose of looking at the budget is so that you can do your financial planning. Majority of entrepreneurs generally don't do any planning and they struggle with setting up a budget. And one of the reasons why most entrepreneurs will struggle to set up a budget is because they have not defined what activities are they going to do for the year. Remember, if you do not know what activities you're going to do, you will also not plan for the resources that you're going to need because you're not going to have a scope or activities that needs to actually be executed. The best way to actually design and build up a budget, one, is to know exactly what activity are you going to do, when are you going to do those activities, and are you going to keep that in-house, i.e. someone in your business is actually going to do it, or are you going to outsource it? If you're going to outsource it, how long does the service provider or a supplier needs to respond so that you can be able to know when exactly are you incurring the expenditure? Number two, once you have set up the budget, you then have to monitor it. There's no point of setting up a control like a budget if you're not going to monitor it. You monitor it in different stages. One, when you are setting up to actually buy the item, before you buy that item, you make sure that there is sufficient money available to purchase whatever that you need to purchase. Number two, when you are paying, you monitor if the payments that you are making is actually talking to the quotation that you got or purchase order, or it talks to the amount that you had set aside. Because sometimes between the timing when you did the quotation versus the time when you're doing the payment, there could have been a price change. The second last part, you also look at the budget in totality so that you can start seeing which items you are having a low spend, which item you are spending faster so that you can make an adjustment. And then at the year end, you look at overall. So you're going to need to look at different stages and period at the item level, which you will do as you're purchasing, and then on a monthly basis when you're looking at each individual line item within your income statement, and then again looking at it half yearly and also at the end of the year. And the purpose of this is to monitor the budget, adjust the budget, and make sure that whatever that you had planned at the beginning of the year or the assumptions that you had set are actually, as things change, you are able to change. Now, the other issue that you need to think about as you're setting up your budget is understanding that things do change. So when you change your strategy, your budget will actually likely to change. So consider those things as you are doing your planning. Understand that budget is just a financial control to help you to know when you're outside of the grid or when you're outside of the parameter you've set for yourself, but also is assisting you to be able to assign your employees to go and procure those things because you've already approved them. And this can be also one of the controls that you put in place when you're delegating some of the financial duties or activities that you're running in your business. Once you have done that, you can actually also use the financial statements to analyze the trends that actually have taken place, maybe comparing from the previous year, but also looking at what are the things that are currently happening in your business that are driving these activities. Now we're going to go to the board for me to explain more in detail on what is it that we will cover step by step, and also show you how will you start and which areas you should watch for, and also watch out for items that are static, that generally do not change. As I said earlier, today we're also going to cover budget. And the reason why most entrepreneurs struggle with the budget is because they generally do not plan their activities for the year, let alone for a month. And they let then the environment and the circumstances then detect to them what should they spend and when should they spend the money. To build up a sustainable business, you are going to need to do planning. But during that planning process, you will need to cost the activities that you'll be conducting. And costing those activities is what we call budget. And there's different types of budget. We have a budget that is actually set using previous year, and we will then roll the current year and change few things and assumptions. But you will also have a budget that is focusing on the sales projections. You will have a budget that is looking at CapEx, operational expenses, and within operational expenses, maybe we'll have human resources budget, you will have marketing budget or digital marketing budget, depending on the activities your business does. In most instances, it's generally really about what do I plan to do in the next 3 to 6 months, and what informs that activity. How will that actually cost? What is it that I want to be done, and how much would it cost? Can I do a scope so that someone can be assisting me to make sure that I can actually deliver on that task? So that is basic principle about budget. Now, when we start looking at the operational expenses, we generally look at the past. How much has been spent in that specific line item? And we then use that to determine the current state, and we also look at what agreements have we signed that are in place. For example, you will look at the previous year rental and say, previously maybe I was paying 10,000 rand per month on a rental. But then you take the current lease agreement and look at it and see what is the normal increase on this lease agreement. How often does it increase, every year or every 6 months? And what percentage does it increase by? And that percentage, is it a variable or is it a fixed? Some contracts, they will say 10% plus inflation. Some will say a straight 15%. Some will say it is negotiable. It will be based on the cost by the landlord. So you really therefore need to analyze your current contracts for you to see going forward how much each item is actually going to cost. Other things that you will need to look at is also salaries and wages. How much are you currently paying your employees? What have you signed with each of the employees? If you have signed a different salary increase, then you will need to effect those when you're doing your human resources budget. And if you are then doing it as an umbrella and saying we're going to actually increase it by inflation rate, that will apply to everyone. So that is usually very easy, but it just gets complex if you have signed different contractual arrangement with different people. Basic principle is that setting up a budget can be quite complex when you are not clear about what activities you need to do, but can also be very easy when you know what activity you're going to do, but you also have done them before. I think because most of the cases you might have not done the activity before, it might actually get to be difficult. You are just learning to figure out how much exactly it will cost you. But you must have an idea as to how much it's going to be, because if you then do not have an idea, you're more likely to actually overspend on the specific item. Remember, everything that you are spending the money on, you must understand it must have a return on investment. Understand that money that you are spending must be able to actually justify that spend based on the revenue that is actually going to bring. Now, I'm going to cover a few items. As I said, there's different types of budget. And for now, I'm going to just look at the CapEx, which is what we call capital expenditure. So, capital expenditure is when we are actually looking at few items which I'm going to outline here on board. Remember, on the previous session, I had spoken about 4 things that every financial person in any organization, whether it's a government, whether it's a listed company, or it's a small business, they actually focus on. I had said that we will have income, we will have expenditure, we will have assets, and we will also have debt. And I said this is what we call financial statements. These 4 things are representative of what financial statements is set up. Now, when you are setting up a budget, you're gonna need to set a budget for all these items. And when I spoke about capital expenditure or capex, I am saying we need to start looking at this block. The reason why I'm always going to start in this block is because I had said in that video, the asset generate income. The income is earned by spending some money, and the money that has been spent is financed by debt. The debt also finances the asset. So when you go through and we say we're going to start with an asset, we basically are going to need to actually list down how much asset are we actually going to need for the next to meet the production requirements or to meet the output that we are looking at. Maybe we're going to need equipment. Maybe we're going to need the machinery. Or maybe we're going to need a vehicle. All of this is what we call capex. It's called in your books, property, plant, and equipment, PPE. Under equipment, you will then say, this is how much I actually will need. Maybe for buying, the cost of buying this equipment, maybe is 500,000. When you put that amount, you must have done some sort of quotation. You must also have done some sort of analysis to understand that to put that equipment to be fully in use, some sort of work needs to be done to prepare the equipment. Some will need engineering, some for commissioning it, some will need certain raw materials, some will need transport. So the cost must include everything up to the point it's ready to actually be used. And that applies the same thing for the machinery and also to some extent a vehicle, depending whether the vehicle is a modified vehicle or non-modified. A modified one, you will definitely need some material. So, and you will put these through and estimate them, get quotations for them, and then you average based on your preferences. And also you will watch out for things relating to guarantees. Assuming you now have listed down, maybe here is 200,000, maybe here it's a truck, is 500K. So here you're now gonna have 1.2 million that you need to actually be your capex. This is how much you're gonna need in your business to build up in capex. But when you build this, you're then gonna need to ask yourself, what would be the cost? What would be raw, repairs and maintenance? And two, what labor is required to manage or to run that machine? And you will also know what would be the things that cover the idle time when the machine is actually not in use. All those, they will be part of the cost. So the cost of running these assets. In other instances, you will also have insurance. For a car, it might actually be a tracker. So on repairs and maintenance, you might actually even include tires. And repairs and maintenance might actually even include some tools that you are using to make sure that the equipment is running smoothly, the repairs that need to be managed. So this is going to be the cost of running, and this cost, we call it expenses. So once you have done your capex, you then have to start analyzing from day one up to the date of disposal what expenses are associated with having that asset. And that will now mean you have taken care of this, you also have taken care of that. Please note, these expenses are only just directly linked to capex. You're still gonna need to then ask yourself, for your business, you're gonna have a sales projections. And in a sales projections, how much are you expecting to earn? And from what you will be earning, what will be the raw materials? Remember when you did costing? What will be the labor? What will be the consumables? What will be the overhead? That also will be an expenses. So then now you will then have been covered. I will then remove this. We will move to sales, which is your sales projections. Now, on the sales projections, we generally will use it. A sales projection is very much similar to, it's like a sales budget of some sort. We are putting through how much we are expecting to make in that line item. The way you will write your sales projections or budget, you will say sales, product A, B, and C. Month 1, month 2, month 3. Your product A, product B, product C, that or service, whatever that you are actually selling, you have to know in which month are you planning to sell 20, 50 items, 20 items. And these estimates, which are in volume, are actually done according to the trend that you'll have noticed in your business. So let me make an example. In an environment where you are operating in your business, you have to know when is what gets sold when. For example, if I'm running a retail shop, I will automatically know that ice will sell mostly in summer, including ice cream and cold drinks. But during winter, I will then be selling more coffee and other warm drinks. And in that understanding, then how that will also detect how I stock, but that will also detect how I actually set up my sales projections. So you're gonna need to know in your business which product gets sold in which period and why, so that you can map up when do you need to actually be focusing on promotion so that those sales actually does get met. You will then run through, and this is generally, as I said, sales will always be on quantity. Because in here, you will then have a price, which is your selling price. Remember though, if you are smart, your selling price should always be based on the customer that is buying, not necessarily on the price that you have set. So the price, maybe let's say he has 10 Rand, he has 15 Rand, he has 20 Rand. That is then gonna get multiplied by the sales that are expected in that period. And that will give you your sales projections. As I said, your sales projection is actually highly influenced by your conversion rate. It's also influenced by you understanding your market and your customers to know that when they will buy and how much they will buy. You may also decide that you're not going to set up your sales projection according to the product. You may decide that actually I'm going to set up my sales projections according to the customers. So you say customer 1, customer 2, customer 3, and. So again, it doesn't really matter as long as it gives you the understanding that this sales projection must be estimated based on the volume and the price, because it should influence by your income. That is going to give you how much you should be expecting. So you have two options there. I generally prefer to list by product and then analyze it later when I'm looking at the actual versus the budget, and then I will look at per customer. As you're building up, we have now done this part, which is your income in your sales projections, we'll now be looking at more detail on here, but also looking at your debtors, which is the liabilities, the money that is your business owe to other people. Remember, the stuff that is here is the stuff that you own, and the stuff that is here is what you owe. This is highly influenced by the assets, is also influenced by how quick are you spending the money in here. Now, when you are building up the money that you owe and when you're going to pay, you will need to follow the same principle we spoke about on managing the cash flow for suppliers. Because usually under debt, the debt is managed by an agreement, the loan agreement. And because of that, it's very therefore easy to say what is the expected payment and when that payment needs to be done, which then will help you to know when should you actually be doing your projections for your cash flow movement, because that's all that is. There is not much you can do because the contract in place is the one that determines when should you actually be paying. But you can then set this up. Remember, when you are paying for the debt, you are paying for two things. You are paying for the interest and you are also paying for the capital portion. The interest will go to income statement, and that the capital portion will actually go to the debt. It will reduce the debt less, and then interest will go to the expenditure, because the cost of the debt is actually interest. I hope you kind of have a clear understanding and approach on how to actually look at the budget. I didn't want to come with a whole lot of different approaches and notes. I just wanted to keep it very simple. In your notes, I have categorized different types of budget so that it allows you to see and categorize according to those business functions that I had previously mentioned, which was business administration, operations, and business development. And I said under each of those, there will be plus or minus 5 business functions that you can then set up the activities in those and cost those activities. So irrespective of which approach you will take, it doesn't really matter as long as you are clear how much am I expecting and how much am I planning to spend on CapEx and how much am I spending and how much am I expected to actually be paying. Budget is easy when you know your activities. It gets difficult when you don't know your activities. It also gets more difficult if you are not planning your activities in relation to the money that you are actually receiving. The money that you are receiving assists you to see, well, how is my cash flow projections going to get affected by my budget? Because if you are struggling with the cash flow, it also indicates that you are not planning for your expenditures. So start planning for your expenditure so that it reduces the risk of the cash flow. Start planning your activities so that you're always going to know what you're going to need for the money and how will you actually get that money. I hope you enjoyed the budget. I will be covering more other items, and I will also make sure that you do have the templates that you will need to actually set up your budget. Templates are well and good. First, understand the principle, then apply the principle on the template. The principle is first set up your activities for the year. Cost the activities, i.e. get quotations for the activities. Once you know the scope of the work and the cost of the activities, you can then ask yourself, when do I want to have this activity being done? You will then plug it in. I'm going to have it maybe in March or whatever period you have set up. But that period will then tell you and inform you on how you will get the money, where you're going to get the money to be able to do that. So that is why I said the cash flow and the budget is very related. Planning starts by you planning your activities and then costing it, and that is what we call financial planning.